Welcome to StokTok's deep dive into ServiceNow Inc. ServiceNow is a cloud software company that provides workflow automation and business process management platforms to enterprises across the globe. At the time of recording, the stock was trading at 90.17. Over the past 52 weeks, the stock has ranged from 81.24 at the low end to 211.48 at the high. The 50-day moving average sits at 104.88, while the 200-day moving average is at 152.51. The relative strength index, a momentum indicator, is at 41.4, suggesting neither overbought nor oversold conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. ServiceNow builds cloud platforms that help large enterprises automate their IT operations, human resources workflows, and customer service processes. The company's core moat rests on switching costs. Once a customer integrates ServiceNow's tools deep into their operations, replacing them becomes operationally expensive and risky. The company also benefits from network effects as more customers connect to its ecosystem. ServiceNow operates on a subscription software model which delivers recurring, predictable revenue. The StokTok Score for ServiceNow stands at 71 out of 100, signaling a buy. Valuation scores 13 out of 20. Financial health rates 18 out of 20. Profitability comes in at 12 out of 20. Growth ranks 20 out of 20, the strongest dimension. Smart money positioning rates 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? ServiceNow's trailing 12-month price-to-earnings ratio stands at 57.95 times. That is an elevated multiple in absolute terms. However, the price-to-earnings-to-growth ratio, or PEG ratio, is 0.64. A PEG below 1 is considered attractive, because it means the market is paying less for each unit of growth than the company is actually delivering. The enterprise value to earnings before interest, taxes, depreciation, and amortization, EV to EBITDA, sits at 31.78 times, which again reflects the growth premium the market assigns to cloud software leaders. The price-to-sales ratio is 7.59 times, which is high but not unreasonable for a software company with ServiceNow's scale and recurring revenue model. In our view, ServiceNow's moat derives primarily from switching costs and platform stickiness. Once enterprises embed these workflows into their operations, the cost to rip and replace becomes prohibitive. The company demonstrates pricing power through its ability to raise contract values over time. From a valuation standpoint, at the time of recording, GuruFocus assigns a fair value estimate of 219.36 compared to the stock price of 96.66, implying a margin of safety of 55.94%. This suggests the stock is trading at a meaningful discount to what some valuation models consider intrinsic value. Wall Street analysts, at the time of recording, have assigned a consensus mean price target of 147, based on the analysis of 44 covering analysts. The high target among these analysts reaches 240, while the low target sits at 85. The next earnings report is due July 22, 2026, with the street expecting earnings per share of approximately 0.86, with estimates ranging from 0.74 on the low end to 0.92 on the high. This represents a near-term catalyst to watch. Peer comparison. Enterprise software companies such as Salesforce and Adobe have historically traded around 25 to 35 times earnings. ServiceNow's forward price to earnings of 23.19 times sits comfortably within or below that range, which provides some relative valuation support. Market sentiment around ServiceNow, as of the creation of this video, leans bearish. Shares have declined significantly despite the company reporting strong earnings and positive artificial intelligence growth guidance. The market has reacted negatively due to concerns about geopolitical risks impacting sales growth and broader software sector weakness, which has offset the company's operational achievements. In our view, this presents an interesting disconnect. Strong operational fundamentals paired with negative near-term sentiment, a setup that sometimes precedes recoveries for well-managed software franchises. Moving to financial strength, how solid is the foundation? The Piotroski F-score measures financial health on a scale of 0 to 9 by examining 9 key accounting metrics: profitability, operating cash flow, leverage, liquidity, and source of earnings quality. ServiceNow scores 7 out of 9, indicating a financially healthy company with no material red flags in its balance sheet construction. The Altman Z score, a bankruptcy risk model used by credit analysts, calculates 5 weighted components: working capital, retained earnings, operating income, market value of equity, and total assets. ServiceNow's Z-score of 5.69 places the company in the safe zone, well above the 3.0 threshold where bankruptcy risk becomes material. The company's cash-to-debt ratio stands at 2.62, meaning for every $1 of debt, ServiceNow has $2.62 in cash and equivalents. This is a fortress-like position. Interest coverage, the ratio of operating income to interest expense, sits at 79.3 times, an exceptionally strong figure that indicates the company could service its debt obligations many times over with its operating income. The current ratio, which compares current assets to current liabilities, is 1.00, suggesting adequate short-term liquidity though not abundant reserves. The debt-to-equity ratio is 0.19, confirming that ServiceNow finances itself primarily through equity rather than borrowed capital. Overall, the balance sheet is one of the strongest elements of this investment. Management has demonstrated capital discipline, maintaining low financial leverage while generating substantial cash. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, measures how effectively management deploys shareholder capital to generate returns. ServiceNow's return on invested capital is 6.95%. For a software company with strong growth prospects, this figure warrants scrutiny. The data suggests that while the company is profitable, the returns on the capital it deploys lag what we might expect from a high-growth enterprise software franchise. This reflects the company's heavy investments in research, development, and sales infrastructure to maintain its competitive position and expand internationally. The gross margin, the percentage of revenue remaining after direct costs of delivering the service, is 77.53%. This is an exceptional figure and underscores the inherent profitability of subscription software. Once infrastructure is built, incremental customer additions carry high gross margins. The operating margin, which measures profit after operating expenses like R&D and sales are deducted, sits at 13.74%. This is reasonable for a growth-stage software company that prioritizes market expansion over near-term profit maximization. The net margin, bottom-line profit divided by revenue, is 13.17%, indicating strong earnings leverage once you account for all expenses including interest and taxes. The free cash flow margin is particularly noteworthy at 34.14%. This means that for every $100 of revenue, ServiceNow converts approximately $34 into free cash flow, or cash available to shareholders after reinvestment. This is a key strength. The business is not only profitable on an accounting basis, but also generates substantial cash. The setup suggests a company that is operationally efficient and capital light relative to its revenue base. On to growth. Is this business expanding, and at what rate? ServiceNow's 3-year revenue growth rate is 22.4%, compounded annually. The 5-year revenue growth rate is 22.9%. These figures are robust and demonstrate consistent expansion over both timeframes. The market is assigning a premium valuation to ServiceNow largely because of this growth trajectory. In the enterprise software sector, a company growing revenue in the low 20s year-over-year while maintaining strong margins is attractive to growth-oriented investors. 3-year book value growth, the expansion of shareholder equity, stands at 35.6%, significantly outpacing revenue growth. This occurs because the company is compounding earnings back into the business and generating returns on that retained capital, even if absolute return on invested capital appears modest. The dividend yield is 0.00%. ServiceNow does not pay a dividend, instead reinvesting all earnings into the business. This is typical for growth-stage software companies that prefer to fund expansion and acquisitions rather than return cash to shareholders. One important consideration: the market is currently pricing in sustained growth, and any material deceleration in revenue trajectory could pressure the valuation multiple. The data suggests the company has delivered consistent growth, but investors should remain alert to signs that the growth rate may be slowing as the company matures and faces larger comparison bases. Now let's talk smart money, what institutional capital is actually doing with this name. 14 top-tier gurus and super investors currently hold ServiceNow, according to aggregated holdings data. This represents meaningful vote of confidence from the most sophisticated portfolio managers. Among the largest holders is Poland Capital Management, which has allocated 3.72% of its portfolio to the position and has been adding shares, increasing the stake by 1.07% during the measurement period. Chase Coleman at Tiger Global Management holds 1.10% of his portfolio in ServiceNow and dramatically increased the position by 41.79%, a substantial new addition that signals conviction. Torrey Funds holds 0.95% and has been reducing the stake by 1.91%, suggesting some profit-taking or rebalancing. Looking at the broader institutional investor base, 13.6% of 13F filers, that is, institutions required to disclose holdings, were net buyers of the stock during the period measured. For context, readings above 50% would indicate overwhelming institutional demand. At 13.6%, the data suggests moderate institutional interest rather than a feeding frenzy. Insider ownership stands at 1.22%, which is quite low. This means the executives and board members own very little of the company they are managing. Some investors view low insider ownership skeptically, as it can suggest management is not personally invested in the outcome. In the 3 months prior to recording, there was 1 insider buy and 4 insider sells. The preponderance of selling by insiders warrants caution and may suggest that company executives are choosing to diversify away from their holdings rather than accumulate them. Taken together, the smart money picture is mixed. Elite super investors like Poland and Tiger Global are interested in adding, but broader institutional participation is modest, and insider selling outweighs buying. This suggests a stock where professional capital is interested, but not uniformly bullish. And finally, the verdict. Let's bring it all together. On valuation, ServiceNow trades at a meaningful discount to GuruFocus estimated fair value, and the price-to-earnings to growth ratio is attractive. Wall Street analysts see upside to 147 from the current price, but sentiment remains bearish due to geopolitical headwinds affecting software spending. In our view, the setup offers an interesting risk-reward for patient investors. On financial strength, the balance sheet is fortress-like with minimal leverage, strong interest coverage, and abundant cash relative to debt. The Piotroski and Altman scores indicate no solvency concerns. This is one of the strongest elements of this investment. On profitability, gross margins are exceptional at 77%, and free cash flow conversion is robust at 34% of revenue. However, return on invested capital lags expectations for a growth company, suggesting capital deployment could improve. The business is fundamentally sound but not yet capital efficient. On growth, the company has delivered 22% revenue growth consistently over 3 and 5 years, which is attractive. Book value is expanding faster than revenue, compounding shareholder equity. Investors are pricing in sustained growth, so any deceleration represents a key risk. On smart money, elite investors like Poland and Tiger Global are holders and buyers, but broader institutional participation is moderate. Insider selling outweighs buying, which is a yellow flag. The data suggests cautious interest rather than overwhelming institutional conviction. Bringing it together, ServiceNow is a financially strong, growing business with a valuable moat, trading at what appears to be an attractive price relative to both intrinsic value models and analyst targets. The primary headwinds are market sentiment pressures tied to geopolitical concerns and the risk that growth may decelerate. Based on what we see in the data, the case for the stock rests on patience, allowing near-term sentiment to stabilize while the company continues to execute and expand. This is not a certainty, and the bear case rests on growth deceleration or prolonged macroeconomic weakness that pressures enterprise spending. Everything in this video is our interpretation of publicly available data and is not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on ServiceNow Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.